So as the euro debt crisis unfolds, the spotlight is now on Italy, where 10-year bond yields are surging. Berlusconi's government set to fall. As developments in the eurozone change by the hour, we turn to Stanley, Chief Investment Officer of Aegis Capital. Good to have you with us, Stan.
Good afternoon. How are you?
Not bad. We were talking a little bit earlier that it seems eurozone politicians are their own worst enemies. What do you think?
I agree. The ones still in power are as well. I think this whole crisis has unfolded really way beyond what it needed to. They did not take the action even a couple of years ago that they really should have, with Greece in particular. And now the math is taking over, and the negative compounding effect exponentially makes it more difficult.
Explain that further to us about how sustainable this math really is, or frankly is not.
Well, Italy's got approximately 2.6 to 2.7 trillion in debt. The original ECB, the European Central Bank target, where they tried to intervene in the market and hold Italian rates lower by buying bonds, and thereby propping up the price and lowering the yield, was originally 4%. And in the summer, when the crisis hit, they tried to keep it at 5%. They failed all through those targets, spent a lot of money, and now Italy debt, as you say, is inching closer to 7. And for some reason, 7 is the magical number of real disaster, so people are very concerned. And the more interest that accrues and compounds and makes Italy's debt, and particularly their rollover of their principal coming due, more expensive, the more dangerous this becomes. And then, does this become a contagion to other weaker credits in the Eurozone, and eventually maybe affect stronger credits?
So this is Greece, Portugal, Ireland all over again.
Yes, with potential effect on some others. Belgium now being mentioned. They just had to step in and support Dexia, one of their banks that failed after passing the European stress test. The biggest problem, though, in the Eurozone is a lack of detail on the plan. Not only that, there are also all the funding mechanisms. They don't have real good mechanisms, first. And secondly, the levels of funding are at the minimums of what everybody expects. So when you put all of that together, it's very disconcerting for the markets, and eventually the markets will vote with their feet, and they will run from Italian debt, as they have.
Now, with this in mind, tell me about the European Central Bank, and frankly other central banks as well. There was a time when they could move the bond market. That doesn't seem to be the case anymore.
That's an excellent point, and one of the things that I've written on lately has been the disconnect between central bank policy, monetary or otherwise, and the real interest rates on the ground. And the more decoupling occurs between central bank policy and interest rates, and the less impact that central banks have on affecting those interest rates, the more dangerous it becomes, and because then they don't have the effect that they thought they could have, and they also spend a lot of money trying to have that effect, and it's wasted. I mean, think of the European Central Bank. They own Greek, Italian, Portuguese, Spanish debt that they tried to support for the past couple of years at prices lower than they paid. So they have effectively, disintegrated that principle, that capital.
Tell me about,
not a good situation.
Tell me about the Berlusconi situation specifically, because we saw the equity markets on the rumor that he was going to be stepping down, but bond investors seem to take a longer view of things, generally speaking. What's your take on this? He's saying he isn't. It's the real back and forth kind of scenario right now. Why would this be a good thing at this time?
Well, I think that people are tired of Mr. Berlusconi, and what I was saying to colleagues today, it was very interesting because post-war, it was almost a running joke how many different governments Italy used to successively have. They used to turn over all the time. I think they had 40-something governments when others were much more stable in the parliamentary system and continually forming coalitions, and yet Mr. Berlusconi has had a very, very long reign, and it's really incredible, particularly particularly going into this crisis. He reminds me of the aging prize fighter who just can't give it up and ends up to be a sad journeyman and getting beat up every night. It's really tough. I mean, I think he needs to go. I think somebody with more capabilities, particularly in the economic area, needs to step in to restore some confidence in the market.
But what about that whole issue of changing horses midstream? Doesn't this just introduce greater uncertainty?
Well, it could, but I think where we are in terms of the markets, I view this as a disconnect between the short term, the very short term, hour to hour, day to day, even minute to minute, the way the markets react and behave, and the medium term. Because I think Greece's solution and Italy's problem in the medium term are both very, very challenging. But yet, when the market gets news, for instance, Mr. Berlusconi was considering stepping down, apparently met with family members, and the market rallied on the fact that he might be out. The same way the Greek market rallied once Mr. Papandreou was pretty much dismissed and a new government's going to be... Because what they're saying is it adheres to what I feel is the inadequate plan in the Eurozone, which is very short-term, temporarily good news. But I think when people start doing the numbers and figuring out how unsustainable, for instance, the Greek voluntary fix is, where they take a 50% write-down, which isn't 50% because not everybody's going to volunteer for that, then they start to really do the math. And I mean, Greece, for one, needs a much more substantial write-down than that. There's precedent for this. Argentina, other countries have had these sovereign defaults and come through. But the interesting thing, it's always been an IMF-led implementation, and I think that's what has to happen this time. You know, turning to Canada, if I might, for a second, this has a huge impact on Canada. Canada is a G20 member. I think Canada can be very influential in this outcome. Canada lost their AAA rating a number of years ago, and they retained their AAA rating because they did the things necessary to restore themselves to that gilt-edged status. And I think Canada can offer a lot of lessons to folks and help this whole circumstance happen. I think it has to be, this is beyond Europe's capability, it has to be a G20-led solution, which down here in the States is very difficult because it's not an easy sell politically for the candidates to go out and say, hey, we've got to help the Eurozone when our own domestic issues are there. But relatively, Canada and the U.S. are stronger than a lot of the other economies in the world. And I think it's time to step up, show that leadership, and most importantly, get the other folks like China, Brazil, and Russia, some of the BRIC nations, to help fund the facility that's necessary for the solution, because we're all interdependent now. There's globalization in financial services, integration in the banking system. This is one world, for whether it or not.
Well, Stanley, we appreciate your insight. Thank you for joining us.
You're welcome. Thank you.
Stanley Crouch, Chief Investment Officer at Aegis Capital.